Hello everyone, welcome back to the channel. Let's keep this simple. The stock market rewards cash flow, not the hype. So today we will talk about 3 companies that keep growing constantly, financially strong and are greater for long-term investors. Adobe, Costco and Broadcom. These aren't speculative bets. They are durable businesses that protect your money and grow it over the time. Let's break them down. Adobe is a software powerhouse. Almost 90% of its revenue comes from subscription, which means predictable income every month. Well, 2025 is operating cash flow around $4.7 billion versus total debt $6.6 billion, which means very strong balance sheet. If you talk about growth potential, mid-single digit revenue growth, small margin expansion and share buybacks. FCF growth around 8% annually. And why it's a good pick? Consumer rarely leave because of switching costs, defensive and consistent growth perfect for volatile market. Costco is predictable, cash generating retail with unique model. And membership fees around $4.6 billion per year are almost pure profit. Debt to equity around 34%, which means very conservative, extremely efficient, high inventory turnover and tight control over expenses. Why it's a good pick? Perform well in good and bad economic times. And for the membership model, it's like steady income and a defensive anchor for your portfolio. And the last one, Broadcom. Broadcom gives you tech growth without extreme volatility, which generates around $15 billion plus free cash flow. Hybrid business, semiconductor plus software is equal to less cyclical swings. So if you talk about returns is greater than 20% on investment capital and pays 2% dividend with double-digit growth. Why it's a good pick? Because it provides both income and growth. Perfect for tax exposure with steady return. How about portfolios and takeaway? These 3 stocks give you diversified exposure. Adobe, software growth. Costco, consumer stability. Broadcom, tech backbone plus dividends. So what are the suggested allocation? 15 to 20% each in equities, and balance is going to be in safer investment. What to monitor? Cash flow trends, debt ratio and valuation. But the main idea is here, buy quality, hold long term and let them grow your wealth. So these aren't risky plays for you. They are strong and cash generating businesses. Preserving capital, let quality compound and enjoy steady growth over time.